The years 2021 and 2022 were all about surging inflation due to the double global inflation shock of COVID supply constraints and then the invasion of Ukraine by Russia. We believe this year will be different, and inflation is set to fall notably, reversing perhaps the majority of the surge over 2021-22. So the heavy lifting by global central banks of tightening monetary policy through raising nominal interest rates is nearly behind us. But monetary policy tightening is set to persist through two channels. Firstly, as inflation falls, policy rates in real terms will continue to rise. And secondly, central banks' balance sheets will see an accelerated and broader decline as we move from QE to QT. We estimate that QT in 2023 across G10 will result in over $3 trillion of shrinkage in global liquidity, with much of this total coming from just the Fed and the ECB. For the Fed this year, this is quite straightforward, given 98% of its balance sheet relates to securities held. So US Treasury bonds and MBS will be reduced by $1.14 trillion this year. For the ECB, its balance sheet is more diverse, with APP and PEP accounting for 60% of total assets, and TLTRO funds another 17%. If all APP securities are allowed to roll off the balance sheet between July and December, and all TLTRO funds are paid back this year, that would result in a €1.6 trillion shrinkage in the ECB's balance sheet this year. So what are the implications for FX? Firstly, policy rate deliberations are likely to remain the dominant influence on FX this year. However, the end of negative rates and the scale of liquidity being removed is already impacting longer-term rates. Since 2014-15, when the ECB introduced negative rates in QE, the 10-year US Treasury bond spread over bunds has been north of 150 basis points most of the time, with flow data indicating sustained selling of Eurozone bonds by foreign investors. That spread is now at 135 basis points, and if maintained, is consistent with a higher euro-dollar. Other factors like risk developments, energy prices in Europe in particular, relative growth outlooks, will mean continued FX volatility. But for euro-dollar specifically, these factors point to a higher euro-dollar this year.